Good morning then everyone on Thursday the 18th of January as we head towards European trade for the day. We'll have a flick across the headlines, see what's going on, what's up, what's down. But a few pullbacks pretty much across the board compared to the moves that we have been seeing recently. Retail sales higher than anticipated yesterday. Again, reaffirms the stance that maybe interest rate cuts are not quite needed as early as markets had priced in. The Fed have never once commented on there being even the potential for six rate cuts this year. They hadn't been open to the fact, or hadn't commented on the fact that they were going to cut rates in March. The market kind of decided that and ran with it. I don't think that's going to be the case. Economic data still, there's nothing wrong with the economic data in the US at the moment, so there's no real need to cut interest rates just yet. Still work to be done on inflation. Now inflation, still 3%, still a little bit high. They want to get that down. And as long as economic data across the rest of the economy remains okay, no real need to cut interest rates just yet, is there? I mean, you can see Asia stocks stumble as China drags. Again, Chinese stocks, it got whacked to begin with in the session, but had a bit of a bounce back just recently over the right into the close, which is, I suppose, a bit of a positive, but still, Chinese stocks at the lowest in years. So, kind of China struggling. Rate cuts, or the rate cut cycle not coming as early as some had initially thought. Obviously not good for global markets. Apart from that, it's kind of just that's the talk in markets at the moment. The Middle Eastern tensions continue. Iran and Pakistan are now going at each other as well. So across the board, I could say across the Middle East, there's conflicts. You got the US and the UK with Houthi. You've obviously got Israel and Palestine in Gaza. You've got Iran seemingly fighting with everybody out there. You got Pakistan and Iran. So you got the tensions in the Red Sea as well. So there's lots of stuff going on in the Middle East at the moment. Lots of conflict in many of the nations around the Middle East. And does that keep oil prices supported in the near term? You have to imagine potentially oil up 1% already. We're not even at the European Open. Stocks not doing too much. No matter where you look, US stocks pretty flat, European stocks flat, as to be expected. They have been having a bad time of it recently, which we'll have a look at when we get around to it. But yields down should provide a bit of respite for stocks at this moment in time, but it's not proving the case. Downside in yields positive for the Japanese yen. FX not doing too much. It's been a pretty quiet Australian Asian session. To kick the day off, stocks. You have to imagine stocks still remain under pressure. You'd have to imagine the US dollar still remains bid. Sterling's up at the moment. I personally would have to imagine that sterling stays bid due to the fact that they have not started the discussion on interest rates and economic data. The unemployment rate remains solid. Inflation higher than anticipated. Again, that's a couple of reasons for them to not even talk about interest rate cuts and not lead markets to believe that the fight against inflation is over, as it's not, as inflation is still at 5% on the core reading. So my bet's US dollar, certainly sterling, to remain underpinned for the foreseeable future. I say foreseeable, certainly in the short to medium term over the next few weeks. Apart from that, you can have a look at the way markets are moving. You can see Aussie, Kiwi, Euro and Sterling. Aussie, Kiwi certainly trending lower. Dollar Yen, Dollar Swiss, Dollar CAD all still trending higher. Euro Dollar has had a bit of a bounce back again. ECB officials pushing back on interest rate cuts as well. So if the US dollar weakens a little bit, Euro Dollar should have a decent pop to the top side. Sterling's been pushing higher ever since the inflation print of yesterday. So US dollar strength still across the board, bit of a pullback. Certainly not unexpected. That's what we're getting at now, and you're probably looking to buy back into the dollar on some of these. Maybe Euro and Sterling are not the best selections at the moment. I think Aussie, Kiwi, Dollar Yen, Dollar CAD, Dollar Swiss, probably better options at this moment in time. You can see the S&P, Dow Jones and Nasdaq, the Russell all still under pressure. The DAX, FTSE both still under pressure. The FTSE got hammered yesterday, big downside yesterday on the price of the FTSE. Obviously inflation in the UK contributing to that. Chinese stocks got pumped Wednesday. got pumped at the beginning of today's session. And you see that big solid bounce back, but ultimately it doesn't really change much in the longer term picture. Also for the other stock markets, I mean the FTSE's after getting whacked, so that's a bit of a different one. But the S&P, the Dow Jones, the Nasdaq, the Russell, they're having pullbacks. The DAX having a bit of a pullback, but it's not exactly a downtrend, is it? You had such euphoria all pumped in the markets, and you have to imagine the fact that trying to work these things out doesn't really make sense sometimes. I mean, you get off the back of the Fed talking about interest rate cuts, back end of last year, you get that sort of a rally. Then they push back on it, and you get a bit of nothing. So, they haven't fully priced out rate cuts. They're just having a bit of a pullback. Is this pullback, long lasting? Probably not. I mean, I said short term over the next week or two, but ultimately at the end of the day, you have to imagine stocks push back higher as certainly the next move, regardless of how many cuts you get. The next move on stock indexes or the next move on interest rates has to be a cut, really, doesn't it? They're not going to go on hike rates again unless you get a big spike higher in inflation, which is a possibility, but certainly not the most likely of outcomes. So the next move is a cut. It's probably difficult to see much downside in stocks, although doesn't really make that much sense if you're expecting a recession to come up. But at the end of the day, you got to do what markets are telling you, and what markets are telling us is certainly stocks don't really care too much about the prospects of interest rate cuts being dialed back. Now, if you did push lower and start to get through some of these near-term lows on the S&P, the Dow Jones, and the Nasdaq, well then that's a bit of a different situation. You got potential for a couple of double tops across these, but certainly in my years of trading, expecting double tops on equity markets hasn't worked out too well. So we'll keep an eye on that. Short term downside, more medium term, probably have to imagine these things pop to the top side again as market participants are reluctant to sell these indexes. Yields continue their trip higher. Had another trip higher off the back of retail sales yesterday. Did have a bit of a pullback then after, but the 10-year yield, 2-year yield continue to push higher. That is likely to continue to put downside pressure on gold, likely to continue to put a bit of downside pressure on stock indexes. So yields will be one to keep an eye on. If they do push higher again, you'd have to imagine stocks still under pressure. Gold stays under pressure, which is what I'll be keeping an eye on coming into today's session. You can see retail sales 0.6% versus a consensus of 0.4%, so pretty strong consumer spending from the US yesterday, which is interesting. Into today, there's not really much economic data today. You can see across the European session, not much really. You got kind of minutes from the ECB at 12:30 today, plus some building permits from the US. But ultimately, I know it says high impact, but it's not really the high impact of high impact data. So yeah, I think we can kind of call today a bit of a non-event, certainly in terms of the economic calendar. Tomorrow you got Michigan consumer sentiment plus retail sales from the UK, so a bit more to go off in tomorrow's session. But this economic calendar is not going to point you in the right direction. You got to look at your cross-asset correlations, look at recent trends, and just study how markets are moving over the course of today, and probably have to back the recent trends prevail. That's it from me then. Best of luck in the European session. We'll be back a little bit later on for a further update.